The pound has been pulling back over the course of the last week or so. Prior to this, we had seen a strong recovery in it against the US dollar over quite a period of time, over quite a number of weeks. But we are starting to see it pull back now. Now, the moves that we have seen over the last month or so have been driven by changing in interest rate expectations. For a time, we were seeing expectations for UK interest rates being ramped up quite considerably, and this coincided with the pound rallying higher. Now that changed from the UK currently seeing interest rates at rock bottom 0.1%. The expectations were that became over the course of a few weeks that we were going to see rates rising quite fast, rising once this year to 0.25%, which is still the expectation, but all then continuing next year, ending the year at around 1.2%. So quite a significant increase in interest rates expected there, considering we've just gone through a decade where interest rate movements have been extremely low. So showing that the Bank of England is becoming increasingly concerned about the pace of inflation here in the UK, which is expected to peak above 5%. So that was starting to be reflected in the markets. Then something interesting happened last week or the week before, and that's what we started to see those expectations start to change slightly, and that change came after the end of next year. So while the expectation was still that we were going to see rates peak around 1.2%, shortly after that, the expectation was going to be that we were going to see it come back below 1%. So that suggested that markets were expecting not only that the Bank of England was going to raise interest rates quite rapidly, but that they were going to make a policy mistake and be forced to reverse course, bringing interest rates back below 1% in line with their longer term expectations. Now, at the same time, the expectation from the US was that we were going to see an interest rate hike maybe late next year, with tapering announced late this year. So a much slower pace of tightening from the US central bank. So that coincided with that rise that we saw in the pound against the US dollar. Now that's paired off over the course of the last week, coinciding with two things. Again, along the line of these expectations, the UK has been pared back a little bit now over the course of the last week. So interest rates expected to be around 1% at the end of next year. That aligns with now expectations for growth in the UK to be a little bit lower, sluggish growth going into the end of this year, but then the mounting headwinds for the economy weighing over the course of the next 12 months or so, be it higher inflation, much higher energy prices, higher taxes, and so on and so forth, squeezing households and businesses and dragging on growth for the next 12 months, maybe even longer, as inflation pressures persist. In the US, expectations for interest rates have gone up a little bit. One or two interest rate hikes now forecasting for these markets over the course of the next year. So that's coincided with that rotation that we've seen off those recent highs in the pound dollar pair. Now let's take a look at it from a technical perspective. As you can see on the chart here, this is a pound dollar daily chart, and you can see that the rotation occurred around that 50% Fibonacci retracement level. Now that's really interesting as far as I'm concerned, because that was a correction of that longer term Fibonacci move. The 50 Fib level also falls around that 200-233 day simple moving average band, which is capped the recent upside moves that we are seeing in the pair. And where we now find ourselves is consolidating between the 50 Fib and the 38.2 Fib, the 38.2 Fib coinciding with that 55.89 day simple moving average band. So a move above the 200-233 would suggest that we're back into bullish territory, and that trend that started late September is continuing. A move back below the 55.89 band and below the 38.2 Fib, so below 137, would suggest that we are actually seeing a continuation of that longer term trend, and that the recent correction in the pound dollar since late September may potentially be behind us. Of course, there's further hurdles that will lie below 136.50, 136 being the next two notable ones. But I think what we're seeing here is that this consolidation in the pair, though, the 137 to the downside, 138, maybe 138.20, 138.30 to the upside. It's these levels that are going to give us insight onto where we can potentially see the next aggressive moves in this currency pairing. Given the fluctuations that we are seeing in interest rate expectations, that is going to ultimately be the major driver as far as these two are concerned, with with those rising in the US and currently falling in the UK. But as a lot has changed over the course of the last month, I expect a lot is going to change between now and the end of the year as well. And that's what makes these markets right now so fascinating.